Hi, I'm John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. I've been working with individuals and couples for nearly a quarter century, helping them to ask the question as to when they can safely retire. Now, first part of that question is asking how much of a nest egg do I need to have saved? And there are ways to kind of come to an analytical conclusion about that. But the more difficult question, both in terms of the complexities, but the psychology of it is, once I have retired, what can I safely withdraw from my savings each year without the risk of running out of money? And that's what I want to talk to you about today. The fact of the matter is these questions are all shrouded in all manners of uncertainty. There's uncertainties regarding, of course, market returns. Most people, even when they retire, need to have their savings, quote unquote, invested in things that will help them grow their assets, provide for their needs, keep pace and outpace inflation. And inherently, market returns are an uncertain and unpredictable thing. We'll talk about that. Inflation. We all know that the cost of living in everyday items that we need, never mind discretionary items, seems to go up over time, and sometimes more violently than others. So that certainly is a factor that will affect the question of how much I can safely withdraw from my savings over time. The other is longevity. Quite simply, the longer one lives in a retirement period when they have to create their own paycheck from their savings, the more money they need or the less they can withdraw. It's that many more years that those funds need to last. And that's a key factor that, again, none of us will know with certainty. And then finally, our own future spending needs. As much as we think we know how we want to live during retirement, what I have learned in my many years of working with people is their visions of what retirement might look like and what it ends up looking like once they're there are completely different. Sometimes they're different in very positive and liberating ways. Other times it's different in ways that one couldn't have imagined, and it maybe puts extra stresses on their retirement period. And these are all things that are important to factor in. I want to start with there's been some rules of thumb that have evolved over the years to help try to answer these questions in a simplified way. And one such rule is the so-called 4% withdrawal rule. I'll get into that in a minute, but that's just one that gets thrown around a lot. Perhaps you've heard of it and rules similar to that. I'll get into the pros and cons of some of these simple rules of thumb and some of the more hands-on ways you can improve the analysis or robustness of your assumptions about retirement needs and spending. So let's talk about the 4% rule. So first of all, it was a rule that was developed by a financial advisor, financial planner in the early 90s by the name of Bill Bengen. He devised this rule by going back and looking at actual stock market returns going back to 1926, I think it was. So a very long period of time. Obviously, there were periods like the Great Depression in there. There were periods like World War II. There were periods like the 70s, which was, defined by high inflation, stagflation. There, of course, was the 1987 crash and whatnot. What we know now, the tech bubble crash before the housing bubble crash and so forth. But it was a rule that basically he went and asked the question, if I had to start a withdrawal from a nest egg and give myself a raise for inflation each year, let's call it 2.5%. What starting percentage withdrawal rate would I be safely able to start from and not run out of money? Assuming, say, a 30-year time frame of retirement, between retirement and death. And his analysis came up with this magical number, right around 4%. And that rule of thumb has been widely used by both professionals like us, but everyday folks looking at their own situation. Now, so for example, let's talk practicalities. If you have $1 million nest egg, 4% translates to $40,000. So in year one, under this rule, you can withdraw $40,000 from your savings. And that's how you start. And then each year you give yourself an inflationary raise. So in year two, take, let's say, 2.5% inflation, give that $40,000 a 2.5% raise, and then an additional 2.5% raise in year three, and so on and so forth. That's the basic premise of the 4% rule. Now, some of the pros of it, it's a very simple, eloquent way to quickly do some quick back of the envelope analysis. And one way it's useful is answering that basic first question, how much of a nest egg do I need? And the way you can do that is you take this 4% rule and kind of mathematically reverse it. In other words, divide 4% into 1, a base of 1. 1 divided by 4% equals 25. Okay, so here's a factor. This is a factor that you can use to multiply against your annual income needs. So if you know you needed, say, $40,000 a year to live on, take that 40,000, multiply by 25, and voila, you have $1 million. That's the magical nest egg you need to support a sustainable withdrawal during retirement. If on the other hand you needed $100,000 a year over and above things like Social Security and pension, take 100 multiply by 25 and you get $2.5 million. So where it's helpful in this sense, let's say you did that math and you needed $100,000 a year, and this rule would say you need $2.5 million, but you have $5 million in the bank, right? This rule of thumb is robust enough for this purpose to conclude, I think, with a high degree of confidence that you are way more comfortable, or you have way more saved than you actually need. In other words, don't worry about retiring. You're going to be okay, and with a high degree of confidence. But the pitfalls of these simple rules of thumb is that they ignore a lot of the real complexities of life, okay? So first off is age. Some people retire early, some people retire late. So by definition, these rules of thumb assume you retire at a quote unquote normal retirement age, say 65. What if you retire at 50? And the simple math of it is that you're going to need much more money, and you're going to have to or withdraw at a much slower rate than the 4% rule would say you could. Vice versa, if you wait to a much later age to retire, well, you need that much less saved and you can withdraw at a higher rate. Okay, and so that's one key limitation of these simple rules of thumb. And related to that is life expectancy. Again, the base assumptions in some of these rules is that you live a typical 30-year period in retirement. And what if you have longevity in your family? Planning out 40, 45 years even or more is a prudent thing. In those scenarios, this rule is going to be overly optimistic and likely determining how much you can spend. And vice versa, if you have health challenges and where it's highly likely that you won't live to a normal full life expectancy, this rule of thumb may have you working longer than you really need to out of fear that you don't have enough money. And that's a equally tragic thing. If time is short, so to speak, you want to spend that time in the most meaningful way as you possibly can. So these are some of the shortfalls or shortcomings of this simple rule of thumb. An additional complication in this simple rule is our spending goals are unknown. A lot of people have visions about what retirement is going to look like for them. And when they get there, it oftentimes looks completely different, either for good reasons. They found new meaningful pursuits that they never imagined they could enjoy during their retirement, and especially if they don't cost a lot of money, it's kind of a win-win. Or there could be other situations where someone had perfect dreams about retiring and moving to a low-cost state, and once they get there, they're miserable, and they need to move back to maybe the high-cost state they came from, and the round trip of that move causes a big dent in their financial picture. These are all things that you can't plan for and certainly aren't accounted for in a simple rule like the 4% withdrawal strategy rule. Another factor is that in reality, most folks' spending in retirement is not linear. This 4% rule is by definition a linear, albeit inflation adjusted rule during retirement. But in actuality, many people go through nonlinear spending. So for example, folks envision maybe traveling and spending money on travel in their retirement. The reality is that early retirees tend to have more vitality and more energy to travel, especially big trips, big expensive trips, than folks as they start getting into their mid and later 70s. So even though the spirit is willing, the body may be weak, and the spending might be earlier on, front-loaded, so to speak, than later on. So $1 when you're 95 isn't nearly as important or as necessary as it is when you're, say, 72 or 70. So that is a very nonlinear phenomena in one's retirement period. Another really key factor is that this simplified rule doesn't take into account the reality of market volatility, and that there are periods of time where investment returns are actually quite disappointing. I can rattle off all the ones that you know about: the tech bubble burst of 2000, the housing bubble burst of 2007 and 8, the COVID crash of 2020, the Great Depression, if you go back far enough. These things are certainly not accounted for in these simplified rules of thumb. And if I could point to the single biggest risk to a successful retirement is, in our very strong opinion, and the mathematics and the modeling of this would bear this out, is suffering a big decline in your nest egg. There's this concept called sequence of return risk, where if you happen to retire and suffer big losses early up front in your retirement period, it can be devastating. You can suffer those losses later on in life and not be harmed too badly. But if you suffer those losses early on in a retirement period, in many ways it could be quote unquote game over. So protecting the downside, especially in markets where there is a high likelihood of disappointing and big down moves. Like, frankly, I think we're in the environment now with valuations of the stock market presently at all-time highs on some metrics, some very reliable metrics. Now's the time to be very careful about protecting the downside. That is perhaps the single biggest important financial planning move you can make, is to just be not overly exposed to market risk at a time when the markets are as overvalued as they are now. There are ways to actually model these things in a much more analytical framework. We have some great financial planning software. There are plenty of self-directed and advisor-driven tools that can look at these things in a much more nuanced and analytical framework that can be very helpful in looking at what-if scenarios and ranges that more accurately reflect the realities of a true retirement period. So, for example, when we look at the actual spending patterns of retirees, it's nonlinear, as I mentioned. So perhaps we can model a scenario where spending is front-loaded and peters out over time. Or the reality is actual spending patterns, no matter what, no matter how assured someone has been by a rule of thumb or a financial plan, I know from working with real people that their behavior is such that when markets are weak and suffer big declines, they lose confidence. No matter what is written on a piece of paper, they lose confidence. They become fearful and they spend less. They pull in the purse strings and they are more conservative. And vice versa, when markets are strong and their investment portfolios are reflecting that, they tend to loosen up the purse strings. They feel more liberated to spend more. So again, maybe a financial plan on paper says you don't have to worry about that, but the real psychological human behavior is to act as such. And we can actually model that and what that can do in a financial plan. You might refer to that as a guardrail spending strategy, where you allow yourself to increase your spending by a certain degree when markets are strong, but also decrease your spending within the realm of discretionary expenses when markets are weak. And that can be modeled in a financial planning software to actually show what that can do to make a situation that much more robust. You can also look at actual return scenarios. Like, for example, we can actually model how would your portfolio and spending strategy look if, for example, you had retired in the year 2000 and immediately suffered the tech bubble burst, followed by the rebound, only to have another 50% burst in the stock market when the housing bubble declined. That's stuff that can actually be analytically modeled and plotted out to give retirees or pre-retirees that much more robust comfort in terms of where they stand in their retirement planning. Starting to wrap this up, I want to make one thing very clear. Sometimes the most fearful things are the questions that you never ask or never try to answer. And here's where taking the step to do some financial planning around these types of things is really important. It may not give you perfect information or perfect clarity as to where you stand, but it should, if done properly, give you enough analytical framework to give you the confidence to take that step, to say that I can retire at a certain flight path from where you might be right now. And it's important to run different what-if scenarios, to stress test the analysis so that when the inevitable uncertain events happen, within a reasonable range of certainty that you're going to be okay. And again, I'll re-emphasize that I think the biggest risk to a financial plan, a retirement strategy at certain parts of the market cycle, like we're in right now, is having too much risk in your portfolio. There are times where the markets are priced to deliver disappointing returns, so-called lost decades, or even worse, big bear markets. And they typically happen when markets are very richly overvalued, like we happen to be right now. And that's not a statement to say that you put all your money under the mattress or put your head in the sand, but it does bode towards a very defensive posturing, scale back your risk. For most people, if you are familiar with hedging strategies, think about ways you can hedge your portfolio to mitigate downside risk. Take a more tactical, risk-focused investment strategy to take chips off the table, if you will, when markets are in kind of trending downward markets. These are all things that a good financial advisor could help you with, or perhaps if you're so inclined, you can do for yourself. But these are really important things at especially the kind of stage of the market cycle we're in now. I hope you found this helpful. There are lots of questions, lots of answers that can be explored through this kind of conversation. I invite your comments to this video. I invite your suggestions for future topics that we can cover in these videos. And if anyone watching this video has questions that they would want to explore as relates to their own situation, I invite you to reach out to the team here at New Harbor Financial Group. There's a link in the bio to this video where you can do that. You can schedule a no obligation free consultation with our team. Our only hope is there to provide some value to you, just in an objective conversation about your situation and how some of these topics may apply to you. I want to thank you for watching. Until next time, I wish you a great day.